Welcome to Talk Tickers. Today we're diving deep into Colgate-Palmolive's latest Q3 earnings report. You know, on the surface, the market's reaction was a bit of a shrug, and that kind of makes sense. There was a solid beat on the bottom line, but it was masking some pretty serious issues just under the surface. So let's get into it.
Here's what we're going to cover. First, we'll hit the headline numbers. Then we'll unpack the big story here, the tug-of-war between price and volume. After that, we'll zoom out to look at the challenges they're facing, and finally, we'll land on our verdict, and even a potential trade idea for the next earnings call.
All right, first up, the raw numbers. This is what really set the tone for the day. At a quick glance, things looked okay, but as you know, the devil's always in the details.
So Colgate posted GAAP earnings per share of 91 cents. Now that's a solid beat. The street was looking for something closer to 89 cents. This tells you they're running a tight ship, really managing their costs and protecting that bottom line. Good stuff there.
Now, what about the top line? Revenue came in at $5.131 billion. And honestly, this was almost exactly what everyone was expecting. It was right in line with consensus. So no real surprise, but, nothing to get the bulls really excited either.
And here it is. This is the number that really tells the story of the quarter. Organic sales growth was just 0.4%. I mean, that is a massive slowdown, and it's the core problem we really need to get our heads around today. So let's put it all together, right? You've got a beat on earnings. Great. You've got revenue. That's fine. But then you have this really concerning slowdown in organic growth, and that explains why the stock was all over the place. It dipped at the open, then fought its way back to close just barely positive. The market is basically caught between rewarding that strong financial discipline and punishing a growth engine that's clearly sputtering. Okay, let's pull back the curtain on that tiny growth number, because it hides the real drama of the quarter, this intense battle between pricing and volume.
So check this out. That whole tiny sliver of growth, it came entirely from jacking up prices. Pricing was up 2.3%. But that was almost completely canceled out by a 1.9% drop in the number of products people actually bought. This is the classic problem, right? They're making more money per item, but they're selling fewer items, and the big, flashing red question is, how long can you really keep that up?
Now, management isn't blind to this. CEO Noel Wallace tackled it right away on the earnings call. He basically said, look, in this volatile operating environment, now is the perfect time to really lean into our new 2030 strategy and get that growth engine firing again.
And what is that plan? Well, it's built on 4 big ideas. They're talking about a new science-based innovation model. Think fancy new formulas to make you feel good about paying more. They're pushing hard on reaching you everywhere, omnichannel. And the big one, a major ramp-up in AI and data analytics. Make no mistake, they're making a huge bet that tech can not only make them more efficient, but actually get people excited to buy their products again.
Now, of course, none of this is happening in a vacuum. To really understand Colgate's quarter, you have to look at the bigger picture, because they're dealing with some self-inflicted wounds and some major industry-wide problems. Okay, first, let's talk about the big one. This was a totally avoidable, massive own goal in Latin America. The company decided to tweak the flavor and formula for their huge Colgate Total brand down there. The result? A wave of consumer complaints about mouth irritation. Ouch! They had to do a massive, expensive product replacement across the entire region.
And the financial hit was no joke. Management put a number on it. It dragged down volume in Latin America by 150 basis points, and it shaved 40 to 50 basis points off the entire company's gross margin. This one stumble was a huge reason the overall quarter looked so anemic.
And if we zoom out even further, look at how the stock has been doing. It's not pretty. Over the past year, Colgate is down over 18%. The broader consumer staples sector, it's down less than 5%. That kind of gap tells you that investors are seeing problems here that are specific to Colgate, not just a sector thing.
But that said, it's not like it's a party for anyone else in this space. The whole sector is feeling the squeeze. Global growth for these kinds of products has basically been cut in half from a year ago. You're seeing way more couponing and promotions in the US, raw material costs are still a pain, and let's face it, the consumer is just feeling a little weaker these days.
So with all that pressure piling up, management did the one thing that always spooks the market. They cut their guidance for the full year. They took that organic growth forecast from a 2 to 4% range and chopped it down to just 1 to 2%. That was the real gut punch from the report, confirming that this Q3 slowdown isn't just a blip on the radar.
All right, so that brings us to the final section. What does all of this add up to? Let's put a rating on this thing and talk about how you might think about positioning for the next quarterly report.
You know, the fundamental question for any investor looking at Colgate right now is, what do you bet on? Do you bet on the company's amazing operational skills and their forward-looking plan? Or do you focus on the fact that growth and volume are clearly heading in the wrong direction?
It's a real tug-of-war. The bulls will tell you, hey, they're experts at controlling costs, this AI pivot is smart, the Latin America issue will go away, and they still own the market. But the bears are screaming, look at that pathetic growth. Look at the volume trends. The whole sector is struggling and their margins are getting squeezed. Both sides have a really strong point. So how might you actually trade this? Well, here's a pretty interesting hedge fund style idea. You take advantage of the fact that Colgate stock just doesn't move that much. Historically, the options market expects a 3.5% swing on earnings day, but the stock only actually moves about 2.4%. So a trader could sell a straddle. That's selling both a call and a put option. The whole idea is to profit when that overpriced volatility predictably vanishes after the earnings report, what we call an IV crush. With all that on the table, we're landing on a market perform rating. Look, Colgate's ability to manage its business and deliver on earnings is truly best in class. It's impressive. The problem is that strength is being totally neutralized by the huge challenges they have on the top line. The company is basically treading water right now, and we just don't see a clear reason it's going to outperform anytime soon. And that really leaves us with the one single multi-billion-dollar question that's going to decide where this stock goes. Can their big bet on AI and innovation actually get people buying more toothpaste and soap before that ability to just keep hiking prices runs out of steam? It's a race against time. And that's the whole story for Colgate-Palmolive.
This is not financial advice.